10 Common effects of inflation. Inflation is the overall rise in the prices of goods and services over time. The annual inflation rate in the United States averaged 3.27% between 1914 and 2022. Inflation facts. 1. Inflation is the sustained and broad rise in the prices of goods and services over time, such as food, gas, and etc., which erodes purchasing or buying power. 2. Inflation is generally caused by an imbalance in supply and demand, supply shocks, and inflation expectations. 3. Inflation causes a recession or depressing resulting to store or business closures, large unemployment, bank closures, increased mortgage, loans or credit card interest rates. What causes inflation? Inflation is the rise in prices of goods and services over a certain period of time. Here are just some causes of inflation: excessive government spending, war, sanctions on countries. U.S. sanctions on Russia, Russia and Ukraine war, and much more. 1. Inflation erodes purchasing power. Compounding ensures that the overall price level increases more than twice as much over the long run if long-run inflation were to double. The Consumer Price Index, CPI, is the best-known inflation indicator, while the Federal Reserve focuses on the PCE price index in its inflation targeting. 2. Inflation disproportionately impacts lower-income consumers. Lower-income consumers tend to spend a higher proportion of their income on necessities than those with higher incomes. This means they have less of a cushion against the loss of purchasing power inherent in inflation. 3. Inflation keeps deflation at bay. The Fed's target inflation rate is set at 2% over the long run. On the other hand, deflation makes it more expensive to service debt in real terms, since incomes would be likely to decline alongside prices. 4. Inflation feeds on itself when it's high. But expectations of future inflation will begin to rise accordingly when the inflation rate accelerates sharply and stays high. Inflation in Weimar Germany. 5. Inflation raises interest rates. As the examples above suggest, governments and central banks have a powerful incentive to keep inflation in check. The approach has been to manage inflation using monetary policy over the past century. 6. Inflation lowers debt service costs. While new borrowers are likely to face higher interest rates when inflation rises, those with fixed-rate mortgages and other loans get the benefit of repaying these with inflated money, lowering their debt service costs after adjusting for inflation. If annual inflation subsequently rises to 10%, the annual decline in your inflation-adjusted loan balance will outweigh your interest costs. 7. Inflation lifts growth and employment in the short term. Higher inflation can lead to faster economic growth in the short term. While the 1970s are recalled as a decade of stagflation, U.S. real gross domestic product, GDP, increased 3.2% annually on average between 1970 and 1979. Well above the economy's average growth rate since. 8. Inflation can cause painful recessions. The trouble with the trade-off between inflation and unemployment is that prolonged acceptance of higher inflation to protect jobs may cause inflation expectations to rise to the point where they set off an inflationary spiral of price hikes and pay increases, as happened in the U.S. during the stagflation of the 1970s. That, in turn, caused unemployment to soar, and to stay high for longer than would likely have been the case had the Fed not allowed inflation to spiral so high. 9. Inflation hurts bonds and growth stocks. As interest rates increase in response to rising or elevated inflation, so does the yield on newly issued bonds. Technology and consumer stocks have lagged during past episodes of high or rising inflation. 10. Inflation boosts real estate, energy, and value stocks. Rising commodity prices can cause inflation to accelerate. Unsurprisingly, energy equities, real estate investment trusts, REITs, and value stocks have historically outperformed during episodes of high or rising inflation. Areas impacted. Inflation can have a positive impact on the economy. As noted above, a little inflation can be a good thing for the economy. Who benefits and who doesn't? As with any other economic phenomenon, inflation comes with both winners and losers. Let's take a look at who gains from inflation and who doesn't. Who it benefits. If you have a rate locked in at 5% and inflation causes interest rates to rise, you won't be affected. That's because higher prices, and, therefore, higher interest rates, often knock out the competition, boosting the amount of inventory available. Who it doesn't. Most consumers tend to think twice about buying a big-ticket item, such as a new appliance or a new car, when inflation is high. That's because higher prices mean higher interest rates, which makes borrowing more expensive. What is inflation's primary effect? Inflation is the rise in prices of goods and services. It causes the purchasing power of a currency to decline, making a representative basket of goods and services increasingly more expensive. How can inflation benefit homeowners?